Hello guys and welcome to my way to fire. Stocks have entered the bear market. In this video we are going to talk about what it means, what caused it and how to react to it. Bear market is a term used when a market falls 20% or more from the recent highs. If we take a look at the S&P 500 we can see that it is down 21% year to date. Apart from the drop itself there is also some pessimism and uncertainty among investors which can drive it even further. Now to calm you down a little, rest assured that there have been many bear markets in the past. The most recent one happened only 2 years ago and didn't last long. The market didn't just recover from it, it broke new all-time highs. But let's get back to today. So the market has dropped over 20%, now what? How long will it last? Honestly I don't know. Could be a couple of weeks but it could also turn into a recession which could last a couple of years. Things like this are very hard to predict. There were people predicting a market crash through 2012 to 2019 while we experienced a great bull run. Had it happened they would have been right. Now most people just forgot about those predictions. While the possibility is definitely there, you don't have any certainty. But what caused the big sell-off? There are many reasons behind the fall we have been experiencing lately. Of course there is inflation which is over 8%, the highest it has been in 40 years. People have a lower purchasing power and need to think twice before buying unnecessary items which results in lower revenues for companies. It will be interesting to see how analysts adjust their earnings estimates for the upcoming quarterly reports. To combat the inflation the Fed started to take action and hike the interest rate. And it will not stop there, the interest rate is expected to keep rising this year and possibly the next year as well. That makes it more expensive to borrow money and results in less investments from companies and people not taking on as much debt. It is one of the most commonly known tools of the monetary policy to battle the inflation. Higher interest rate makes bonds more attractive and investors might shift more money there. It also makes investors rethink how much they are willing to pay for different stocks. Then there is the Russian war against Ukraine which stops Ukraine from exporting very large quantities of grain and other food. Many countries stopped or want to stop buying oil and natural gas from Russia which led to a surge in price of these commodities. China has its zero-COVID policy and shuts down whole cities with millions of people causing huge economic losses. The supply chain is still disrupted. So what can you do? If you are in it for the long run like I am, then don't panic and don't sell your stocks when they are down. Don't get distracted by the red color and stay focused on your goal. Think of this as a great opportunity to buy for a lower price. If you are shopping and see something is discounted you are happy to buy it. This is very similar. Be aware that the market can go even lower, but if you invest regularly you have the benefit of dollar cost averaging, so you will just lower your average price. Nobody knows how long it will last and timing the market is a terrible idea. That has been proven many times and you just can't hit the sweet spot. Another thing to do is to have an emergency fund ready, if you don't already. Usually a 3 to 6 months worth of expenses is advised, but if you want to be extra sure you can do more. Just don't overdo it because that money loses its value to inflation as well. Have it on a savings account so it is ready anytime you need it, just in case something should come up. Guys, if you enjoyed this video and found it helpful, please hit the like button to support this channel, and if you are interested in more videos about investing, personal finance and just overall money related topics, then make sure you subscribe. As always, thank you so much for watching and I hope to see you in the next video.